Imagine you are 52 years old, completely exhausted from grinding for 30 long years, sitting on $2 million. You did everything absolutely right, maxing out your retirement account every single year, constantly securing that free employer match money. You invested safely in low-cost index funds, surviving every market crash perfectly, and can now live on $60,000. Your massive nest egg could sustain you forever, so you are entirely ready to retire, knowing you finally earned it. But here is the major problem making me genuinely frustrated with how retirement accounts are strictly structured in this country. You simply cannot touch that hard-earned money without getting absolutely hammered by massive financial penalties from the federal government. That huge pile of money is sitting right there. You saved it, but trying to access it early brings penalties. The Internal Revenue Service will take a 10% penalty right off the top, plus you owe standard income taxes. On a standard withdrawal, $20,000 goes straight to the government every single year for nearly a full decade total. So, do you keep working a terrible job you hate just because your wealth is trapped inside the wrong account? This is the dangerous timing mismatch nobody ever talks about when they loudly tell you to max out your 401k. My name is Pete, and today I will happily show you exactly how to permanently solve this massive retirement problem. The mainstream financial advice industry has done a fantastic job convincing absolutely everyone to put their cash into a 401k. The initial tax benefits are definitely real, but relying solely on these accounts creates a massive problem for early retirees. You ultimately end up with a ton of wealth that you cannot legally access when you actually need it most. You are essentially building a beautiful golden prison that you cannot easily escape from without paying very heavy financial fines. Today, we're going to carefully discuss the ultimate solution, something that I always like to call the bridge account. This is a standard taxable brokerage account specifically designed to comfortably fund your life during those crucial early gap years. It perfectly covers the time between early retirement and when your traditional retirement accounts finally become legally accessible, penalty-free. This special account is the absolute missing piece of the early retirement puzzle, and I will explain its perfect construction. Let me explain the fundamental problem with how most ordinary people are currently saving money for their future retirement years. The traditional 401k was explicitly designed in 1978 simply as a helpful supplement to traditional corporate pension plans. The basic assumption built into its original structure was that you would work comfortably until your mid-60s receiving pensions. The 10% early withdrawal penalty was purposely designed as a strong deterrent to stop people from quickly raiding savings. But standard pensions have basically disappeared entirely. Life expectancy has dramatically increased, and many people simply cannot work forever anymore. Nearly 40% of retirees actually leave the workforce much earlier than planned due to serious health or caregiving responsibilities. We have an outdated system designed around working until your 60s, combined with a strict penalty severely punishing early access. By aggressively saving only in your restrictive 401k, you are basically making a blind bet that you will work forever. You are tightly locking your hard-earned money away until a specific birthday, completely destroying your option to stop working. Even if you have millions saved, if it is all totally pre-tax money, you lack actual, true financial freedom. Now, you might be thinking about loopholes like the Rule of 55 or complicated Roth conversion ladder strategies today. While these advanced strategies certainly exist in reality, they are extremely limited in scope, highly complicated, and require advanced planning. The absolute simplest, most flexible solution is to smartly build a bridge account that you can access whenever you want. There are absolutely no federal penalties, no complicated rules, and no frustrating waiting periods preventing you from using your money. A bridge account is simply a standard taxable brokerage account legally held at major institutions like Fidelity, Vanguard, or Schwab. You fund it with after-tax dollars, and unlike traditional accounts, there are zero contribution limits or early withdrawal penalties. When you finally sell your profitable investments, you simply pay standard capital gains taxes on the profits and nothing else. If you really need the money at age 45, you can freely take it with complete and total flexibility. Think of your overall retirement savings neatly divided into 3 completely separate and highly strategic financial planning investment buckets today. Bucket 1 holds your tax-advantaged accounts like the 401k, offering great tax treatment but locking funds until age 60. Bucket 2 contains your Roth accounts, where initial contributions are somewhat flexible, but the investment earnings remain completely locked up. Bucket 3 is your brilliant bridge account, which receives no special tax treatment but is totally accessible at any time. Let me give you a very concrete example of exactly how this powerful 3-bucket system works in practical reality. Let us easily say Maria is 35 years old, making great money, and wants to retire at age 50. She must carefully fund 2 distinct phases of retirement: the initial bridge years and the traditional later retirement years afterward. For the critical bridge years, she needs exactly 9.5 years of living expenses easily accessible without penalty. If she annually spends $60,000, she desperately needs exactly $570,000 sitting in her bridge account. For her traditional retirement years, she only needs her 401k to handle everything smoothly from age 60 until she passes. Maria must successfully build the bridge account by 50 and let the traditional retirement accounts strictly grow until age 60. Building a strong bridge account is actually very highly achievable for ordinary people with decent incomes willing to prioritize it. The first major step is perfectly calculating your exact bridge period, meaning the specific years before age 60 finally arrives. If you truly want to retire at age 50, your exact bridge period is exactly 9.5 years. The second crucial step involves estimating your realistic annual living expenses required during this specific bridge period timeframe perfectly. These expenses are mostly lower than pre-retirement spending because you quickly eliminate commuting costs, work clothes, and standard taxes. Let us use $55,000 as a very reasonable middle ground example for a comfortable early retirement budget. The third critical step is calculating your ultimate bridge account target by simply multiplying annual expenses by your bridge period. You should always carefully add a 10% buffer for unexpected investment fluctuations and completely random emergency living expenses too. To build $600,000 safely in exactly 15 years, you must consistently invest $1,900 every month. Building this extremely vital account successfully requires a high income, low living costs, or drastically reducing your current 401k contributions. Here is the major hidden trade-off nobody talks about when eagerly discussing the absolute fastest path toward financial freedom. If you actively plan to retire at 50, blindly maxing out your traditional 401k account might not be truly optimal. You should simply contribute just enough money to get the full employer match, entirely capturing that free cash without question. Then, forcefully redirect every single remaining investment dollar straight into your taxable bridge account to slowly build your escape fund. You are willingly giving up minor short-term tax advantages to permanently gain the massive flexibility required for early retirement. Always perfectly remember, money you cannot easily access when you need it is functionally useless compared to fully accessible wealth. The later you actually genuinely want to officially retire, the significantly smaller your required bridge account needs to be eventually. Retiring at exactly age 50 heavily requires a massive bridge, while retiring at 57 requires a surprisingly small bridge. Taxable brokerage accounts are not actually as extremely tax inefficient as most standard financial advisors will usually confidently assume today. Long-term capital gains are legally taxed at amazing preferential rates if you simply hold the specific investments for years. If your total married taxable income forever remains below $89,000, you will clearly pay exactly zero taxes. An early retiree comfortably living on $50,000 annually could potentially pay absolutely no federal income tax whatsoever, forever. In a standard taxable account, you uniquely possess complete and total control over exactly when you legally realize your gains. Furthermore, when you inevitably pass away, taxable brokerage assets amazingly receive a massive step-up basis, completely saving your heirs. To effortlessly maximize your ultimate tax efficiency, you should heavily invest in broad market index funds from Vanguard or Fidelity. As you slowly approach your early retirement date, you must strategically shift your bridge account allocation to become much safer. The important money completely needed for your first 3 years of absolute freedom should sit safely inside short-term bonds. Stop treating your restrictive 401k as your only retirement plan and start quickly embracing the 3-bucket system today. The ultimate breathtaking beauty of the remarkable bridge account strategy is that it finally gives you total control over destiny. You will finally possess the absolute financial freedom to permanently walk away from work on your own specific personalized timeline. Thank you for watching. Please like this video, subscribe to Pete Invests, and finally turn on the notification bell now.